Welcome to the stay-at-home economy. With the coronavirus on the verge of becoming a full-blown pandemic, the going-out stocks keep getting battered. As I've told you over and over, companies that rely on groups of people congregating in one place are right in the blast zone. Airlines, cruise lines, casinos, live entertainment, lodging, and restaurants, they've all been pulverized. And no wonder that these industries don't work when people are afraid to go outside. And COVID-19 has us very, very afraid. I'm worried about every one of those industries and the balance sheets within them. They are where the holes are. They and the oil and gas companies let's say, they have me concerned. I'm not hysterical like so many people. I'm concerned. I'd be a joker not to be. But people don't totally stop spending money just because they stop going out. And we still need to find ways to occupy our time. And that's why we're embracing the new stay-at-home economy. It's a good theme here. What works in this difficult environment are companies with products that you can enjoy from the comfort of your own home. Yes, from the couch. The streaming video services, the video game publishers, the software companies that enable you to work from home, and all the packaged food companies that make it possible to survive even without great taste while not leaving your house. COVID-19 didn't create the stay-at-home economy. You know, we spent years here moving in that direction. I actually started pushing this thesis way back in 2017, but this outbreak's pouring fuel on the stay-at-home fire. So let's revisit the Mad Money Stay-at-Home Economy Index. Yeah, 3 years ago, we rolled out the first iteration of this list, and Domino's Pizza, Wingstop for delivery, Pepsico for eating at home, Home Depot and TJX for home improvement, the big three video game publishers, Activision, Blizzard, Electronic Arts, Take-Two Interactive, the two graphics chip makers, AMD and NVIDIA, along with Amazon, Microsoft, and Facebook. Yeah, then we had Ulta Beauty so that you could look your selfie best on Instagram. We also bundled in some experiential economy stocks that really don't work here anymore, like Carnival Hard Pass. Since then, our stay-at-home stocks have rallied an average of 90%, trouncing the 35% gain in the S&P 500 over the same period. The only loser in the stay-at-home cohort was, of all things, Ulta, a retailer that never should have been on that list in the first place. They report next week. Over the course of 2017, we added more names. Netflix, obviously. Grubhub for delivery. Alphabet and Apple, because they make it easy to keep yourself entertained on the web or on your phone. In 2018, we added more food stocks. We took about McCormick for spices. I really stand by this one, by the way, in this market. And seasonings. Conagra for packaged stuff, just so-so quarter. I recommended Disney, which was just starting to noodle on the streaming idea. Spotify for music, and Prologis for logistics for the stay-at-home economy, which is so important because it rests on getting packages to your house on time, and that's what Prologis helps them do. In the video game space, I told you to steer clear of EA and focus on Take-Two and Activision. I started recommending Shopify, too, which has been a spectacular winner. It's up 246% since then. And I've got to tell you, Shopify's not done going higher. So which of these stay-at-home stocks still worth owning? And what stays, what goes? First, the obvious. I want you to forget all the experiential stuff. No Ulta Beauty, no cruise lines. The experiential economy thesis was struggling even before the coronavirus. Now it's dead, at least until the outbreak's over. Next, let's go over group by group, starting with FANG, Facebook, Amazon, Apple, Netflix, and Google, now Alphabet. These are all straightforward stay-at-home plays. They're, by the way, very little China exposure, too, except for Apple. They're your content providers. They keep you entertained or keep you supplied with necessities. Facebook, Amazon, Netflix, and Alphabet are all worth picking at due to the weakness. I am not as concerned as others that the ad dollars will dry up. People will shop more online, so the ad dollars will gravitate toward these companies. Apple's a little more complicated because it has significant China exposure, both in terms of its supply chain and as one of its largest markets. Still, it's a great long-term story. At times like this, I say stick with my mantra of own Apple, don't trade it. I know a lot of people are banning Apple. 2 negative notes just this morning. Could it go down? Of course it's a stock. Do I like it? You bet. We got a couple of e-commerce plays like Shopify and Prologis. I think they're still work. With Prologis, you can get by this logistics REIT and hold it on for ages. Shopify's a high flyer that's still not very profitable, but that's up to them. So it tends to be a volatile stock. But given that it's now down more than 120 from its highs, you got my permission to start nibbling. Video games. The big publicly traded gaming stocks have been hit or miss over the last couple of years because they were slow on the uptake with some big new trends like Fortnite-style free-to-play games. That said, I still like Take-Two Interactive. I know this quarter wasn't perfect. And I like Activision Blizzard. Activision in particular seems the best read on the mobile gaming, which is why it's been outperforming peers of late, although my Campbell Trust did sell it. I think you can stick with NVIDIA and AMD, too, the latter of which just had a fabulous quarter, but was completely ignored. Analysts being completely ignored because of COVID-19. By the way, it did finish up on the day If the market had been up today, the stock would have been up 3. How about the packaged food place? All right, PepsiCo, sticking by that. McCormick, perfect for the moment. Steady Eddie companies that help you eat from home. Oh, and if you get the coronavirus, it can't hurt to replenish your electrolytes with Gatorade from PepsiCo. Delivery, on the other hand, horror show. That's why I spent most of last year telling you to avoid Grubhub before the stock got obliterated. Too much competition. That said, Domino's and Wingstop are both working. Restaurants that deliver definitely fit into this model. Remember, Domino's had a great last quarter. I like what we've heard from both CEOs. The retailers, I originally recommended TJX and Home Depot as home improvement plays. I like them both, but they don't really fit the stay-at-home business, that kind of thesis that I wanted. How about Disney? On the one hand, the stock has pulled back dramatically, even as their streaming service is on fire. On the other hand, Disney's parks will take a huge hit from the virus. Their movie business might have trouble, too. As much as I like this one long-term, it's too experiential for the stay-at-home economy index. For those who are wondering about Disney, My Travel Trust, we think that the stock has one more leg down if they have to close the parks. Then there's Spotify, which simply hasn't worked since it started trading here a little less than 2 years ago. I'm not actually sure why. I'm sick of defending it, though, so I'll take a pass. So we get 15 old stay-at-home stocks. Facebook, Apple, Amazon, Netflix, Alphabet, Shopify, Prologis, Activision, Take-Two, NVIDIA, AMD, PepsiCo, McCormick, Domino's, and Wingstop. Now, let me add some new ones that directly address the epidemic. First is Costco, which we own for the Travel Trust. Costco reported a strong quarter last night, even if the stock still got slammed today. That's a gift. On the conference call, Costco's management said they're benefiting from the coronavirus as consumers stock up on essentials. That call's actually essential reading because Galanti, who's the CFO, did such an amazing job. You'll feel like I do if you read it. Second is Etsy, the online marketplace for handicrafts. As CEO Josh Silverman told us last week, Etsy's a work-from-home facilitator, and they just reported a strong quarter. You can buy it in stages on the way down. All right, well, then you had a really good quarter this week. Campbell Soup, exactly what you stock up on when you're worried. You might be stuck at home for weeks in. We did. Campbell's rallied hard on Wednesday after reporting a great quarter. But since then, it's given back most of its gains. Therefore, it's really interesting to me. Now, fourth is one that I've often joked about as Cramer Family Club. It's Okta. That's the cloud-based cybersecurity company that handles your login and your verification credentials. In other words, their technology makes it easier for people to work securely from home. Hey, listen, Okta just reported a blowout quarter last night, and their earnings forecast a little light, so the stock fell $3 today. You can start buying here and then add more if it goes lower. I think that the stock would have been up 20 if the NASDAQ hadn't been obliterated most of the day. And then finally, one that everyone's decided is no good and they're quite wrong, which is Zoom Video. That's the cloud-based video conferencing play. Zoom may be the perfect stock for this moment because companies still need to hold meetings, even if people can't physically come into work. They posted some excellent numbers on Wednesday night, which allowed the stock to surge yesterday, although it's now given back that entire gain. I say sold to me. Bottom line. After another panic week where the doom and gloom dominated the headlines, I want to help you identify stocks that are worth buying into weakness. And I think these 20 stay-at-home economy plays, and I know there's 20, that's a lot. I'm sure someone will take it and steal it, call it an ETF, make $240, I don't know, $8,000 the instant that they do it, and then $4 million, not credit me, and think, you know what? That Cramer's an idiot. He gave it to us for free. You know what I have to say? I'm an idiot. I gave it to you for free. Frederick in New York. Frederick.
Booyah, Jim. This is Marco, Frederick's dad. I'm going to put him on the phone.
Oh, boy. Here we go, guys.
Booyah, Jim Chill.
Jimmy Chill is in the house. Let's go to work.
I want to invest my communion money in a company that's run well and gives a good dividend. What do you think about Nike?
About Nike?
Mm-hmm.
Nike? I think for someone, I mean, obviously Frederick's a younger fella. Nike's got a good long-term perspective. Short-term, I think you might find yourself buying some here and buying some at 82. But that's okay, because I think that you'll do fine in the long term. Jimmy Chill is the term that my oldest daughter came and said, Dad, you got to chill. On the Twitter, you got to chill. You want to be Jimmy Chill. And now everybody seems to like it so much that, hey, I can be Jimmy Chill. Doom and gloom are dominating these days, but there are still opportunities out there in the stay-at-home economy. Look at this, including Cramer family fave, Okta. All right, much more Mad Money ahead. After 15 years at the helm of Mad Money, I've had plenty. No, I'm not tired. I've had plenty of experience in market turmoil. I'll tell you why this moment feels different than the others. Plus, my exclusive with the woman who some call the most powerful woman on Wall Street. I say maybe the most powerful person. I'll ask Sally Krawcheck what she makes of the recent volatility. And she's a friend. All your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.